Just about through the first half of the year, and my next guest is calling the S&P run overdone at current valuations, saying to not expect more upside heading into the second half. Let's bring in SoFi's Liz Young. It's good to see you. I mean, look, let's be honest. You were surprised. You've been surprised by how strong this market has been through the first half, and you say ultimately what? It's going to catch up with itself and it just can't continue?
Well, Scott, this is the point in the year when everybody who writes an annual outlook has to sit back and say, how am I doing? How's it going? And the title to my annual outlook in 2023 was This Ends One Way or Another. I think we gave a good hard run at ending the cycle in March, and it didn't quite do that, but we did have a little scare. And now here we find ourselves at valuations in the S&P above the 5-year average, the 10-year average, and the 15-year average at a point in the cycle when we are sufficiently restrictive, I'll call it sufficiently restrictive on monetary policy, and looking kind of down the barrel of will we have a recession or not? It becomes closer and closer in time as the months drag on. So I do think that we're going to have some sort of give back. We're already seeing that a little bit in some of these tech names. I heard the interview with Dan Ives. I think that his thesis on AI and the idea that this is the beginning of a bull market for tech probably makes sense longer term, but there are a lot of investors who got in at pretty inflated valuations and are probably going to be looking for that gratification sooner rather than later. And I'm not sure that they're going to get it in the next 3 to 6 months.
Is your problem with the market at its current levels that earnings are just not going to justify where multiples have expanded to?
That's part of it, because you do want to hear something about the fundamentals improving at the same rate as valuations are going up, and that's not necessarily something that we've heard. Now, I recognize we haven't had fundamentals that deteriorated as quickly as many of us expected, both on the macro side and on the company-specific side. But as inflation comes down, there's a couple different forces. You look at how the consumer feels, and you see how sentiment has sort of leveled out or even gone up over the past couple months. But that's a result of inflation coming down and the market going up. Consumers are going to feel good about that, and the labor market still being strong. As inflation continues to come down, which is what we all want, revenues come down with it, because you just can't maintain that pricing power that companies have had for the most part of this cycle. And then competition picks up again. And that happens right around the same time that consumers may be pulling back their spending if they're worried about a slowdown. So I'm skeptical of revenues hitting target for the rest of the year, in which case margins are going to be under pressure. And I think a lot of the expectations, particularly into 2024, are for margins to start expanding again. And the expectations for earnings in 2024, which we'll now start talking about after June finishes, are pretty lofty given where we think inflation and revenues are going to kind of fall out.
You still say there's a good chance, though, that the Fed is done, to which some would suggest, well, that's just a positive no matter what, a net positive, because the next thing that comes, if they're done, is cuts.
That's a net positive if you are in a different part of the cycle. I believe that we are decidedly late cycle right now. And this is something that when you look at some of the signals, this is much like the yield curve inversion. It's not the inversion that's the problem. It's the re-steepening that's the problem. Same thing with Fed moves. It's not the hikes necessarily that are the problem. It's not the pause that are the problem. It's the cuts that are the problem. And I think the optimistic view is that the Fed will be able to slowly cut rates, get back down to a normal level as inflation cools without really breaking anything in the economy. But at these levels, number one, of inversion, and at these deep levels of LEI contraction, the leading economic indicators contracting, it's really never happened before that they've been able to normalize and get on that path without some pain in the midst of it. Now, of course, things that have never happened before happen all the time. I understand that, and I think that this cycle has been a surprise to many of us. But it is a difficult thing to imagine that we re-steepen a yield curve, come out of LEI contraction, and kind of whistle on our merry way through the rest of this cycle without any bumps in the road.